In this lecture, we are going to discuss two major topics: function of financial markets and the structure of financial markets. And regarding first topic, which is function of financial markets, we are going to explain indirect finance, direct finance, and the role of financial markets in the economy. But regarding the structure of financial markets, we are going to explain the following topics: debt and equity markets, primary and secondary markets, exchange and over-the-counter markets, and finally, money and the capital markets. Function of financial markets. Financial markets perform the essential economic function of channeling funds from households, firms, and governments that have saved surplus funds by spending less than their income to those that have a shortage of funds because they wish to spend more than their income. This function is shown in the following figure. In direct finance, at the bottom of figure, borrowers borrow funds directly from lenders in financial markets by selling them securities, also called financial instruments, which are claimed on the borrower's future income or assets. Securities are assets for the person who buys them, but they are liabilities for the individual or firm that sells or issues them. For example, a General Motors needs to borrow funds to pay for a new factory to manufacture electric cars. It might borrow the funds from savers by selling them a bond, which is added security that promises to make payments periodically for a specified period of time. Or a stock, which is a security that entitles the owner to a share of the company's profits and assets. Indirect finance, in which a financial intermediary borrows funds from lender savers and then uses these funds to make loans to borrower spenders. Now, we can see why financial markets have an important function in the economy. First, they allow funds to move from people who lack productive investment opportunities to people who have such opportunities. Second, financial markets are critical for producing an efficient allocation of capital, like wealth, either financial or physical, that is employed to produce more wealth, which contributes to higher production and efficiency for the overall economy. Third, well-functioning financial markets also directly improve the well-being of consumers by allowing them to time their purchases better. The structure of financial markets. Now that we understand the basic function of financial markets, let us look at their structure. The following descriptions of several categorizations of financial markets illustrate the essential features of these markets. First, debt and equity markets. Second, primary and secondary markets. Third, exchange and over-the-counter markets. Fourth, money and the capital markets. Debt and equity markets. A firm or an individual can obtain funds in financial market in two ways. The most common method is to issue a debt instrument such as a bond or mortgage, which is a contractual agreement by the borrower to pay the holder of the instrument fixed pound amounts at regular intervals until a specified date, which is called the maturity date, when a final payment is made. The maturity of a debt instrument is the number of years or term until that instrument's expiration date. Also, a debt instrument is short term if its maturity is less than a year, and long term if its maturity is 10 years or longer. Debt instruments with a maturity between 1 and 10 years are said to be intermediate term. The second method of raising funds is by issuing equities, such as common stock, which are claims to share in the net income after expenses and taxes and the assets of a business. Equities often make periodic payments, which are called dividends, to their holders and considered long-term securities because they have no maturity date. In addition, owning stock means that you own a portion of the firm and thus have the right to vote on issues important to the firm and to elect its directors. Note that the main disadvantage of owning a corporation's equities rather than its debt is that an equity holder is a residual claimant. That is, the corporation must pay all its debt holders before it pays its equity holders. And the advantage of holding equities is that equity holders benefit directly from any increases in the corporation's profitability or asset value. Primary and secondary markets. A primary market is a financial market in which new issues of a security, such as a bond or a stock, are sold to initial buyers by the corporation or government agency borrowing the funds. An important financial institution that assists in the initial sale of securities in the primary market is the investment bank. It does this by underwriting securities. It guarantees a price for a corporation's securities and then sells them to the public. Note that the primary markets for securities are not well known to the public because the selling of securities to initial buyers often takes place behind closed doors. A secondary market is a financial market in which securities that have been previously issued can be resold. Examples of secondary markets are foreign exchange markets, futures markets, and options markets. Note that securities brokers and dealers are crucial to a well-functioning secondary market. Brokers are agents of investors who match buyers with sellers of securities, but dealers link buyers and sellers by buying and selling securities at stated prices. Also, when an individual buys a security in the secondary market, the person who has sold the security receives the money in exchange for the security, but the corporation that issued the security acquires new funds. A corporation acquires new funds only when its securities are first sold in the primary market. Secondary markets serve two important functions. First, they make it easier and quicker to sell these financial instruments to raise cash. That is, they make the financial instruments more liquid. The increased liquidity of these instruments then makes them more desirable and thus easier for issuing firms to sell in the primary market. Second, they determine the price of the security that the issuing firm sells in the primary market. The investors who buy securities in the primary market will pay the issuing corporation no more than the price they think the secondary market will set for this security. The higher the securities price in the secondary market, the higher the price that the issuing firm will receive for a new security in the primary market, and hence the greater the amount of financial capital it can raise. Exchanges and over-the-counter markets. Secondary markets can be organized in two ways. One method is to organize exchanges where buyers and sellers of securities or their agents or brokers meet in one central location to conduct trades. The New York and American Stock Exchange for stocks and the Chicago Board of Trade for commodities, wheat, corn, silver, and other raw materials are examples of organized exchanges. The other method of organizing a secondary market is to have an over-the-counter market in which dealers at different locations who have an inventory of securities stand ready to buy and to sell securities over the counter to anyone who comes to them and is willing to accept their prices. Money and capital markets. Another way of distinguishing between markets is on the basis of the maturity of the securities traded in each market. The money market is a financial market in which only short-term debt instruments, generally those with original maturity of less than 1 year, are traded. The capital market is the market in which longer-term debt, generally with original maturity of 1 year or greater, and equity instruments are traded.